Welcome to our YouTube Live, and this is just a chance to summarise what I think of what the Bank of England's done and also go through exactly what happened, but also some of the economic data behind it. And of course, we were here yesterday talking about the Fed, and it's quite a different story, as we'll see, with the Bank of England, although the end result, which is that they didn't change rates, was exactly the same. So let's just start off with the overall decision. They've kept the bank rate at 5.25%, and that's what many people expected. It's what markets expected. And inflation has been falling, so that's the good news. And it's actually falling faster than the Bank of England expected last time they published an outlook, which is also a positive development. Global factors that previously pushed up prices in the UK, that's supposed to be fading according to Governor Bailey, and the decisions they've taken on interest rates are also helping to bring inflation rates down. So generally a good backdrop, which is inflation's falling, it's getting closer to the 2% target. It won't actually have to reach the 2% target for them to stop for them to start cutting rates. So even if it's not at 2%, they can already start cutting rates, which means that probably sometime later this year, we're going to see some rate cuts. And markets are expecting that there are going to be about 3 rate cuts this year now, which is kind of similar to what they expected about the Fed. And I think that's probably quite likely. So if you're about to have your mortgage reset, if you're one of the million people in the UK that's going to have to remortgage this year, and you're coming off a very low fixed rate to a much higher rate, you're probably relieved to hear that rates are probably going to fall, bank rate will fall, and that could push down the rate at which you borrow if it happens after that cut. Probably it's not going to be May, probably June. That's probably going to be the time when the rates happen, maybe as late as August. But certainly this year, I think it's almost a certainty that the bank will start cutting rates, unless we get another inflation spike, of course. So let's just go through some of the data that the bank depends on and which leads to these decisions, because I think it is important to understand the backdrop before you make any judgments about what they're about to do. So let's have a look at that. So this was the tweet that came out today from the Bank of England. Of course, the tweet is all we got. We didn't get a press conference. We got one tweet from the Bank of England governor, which had a video in it where he spent 2 minutes talking about why they did what they did. But the majority of the Monetary Policy Committee members voted to maintain the bank rate at 5.25%. Interestingly, none of them this time decided that they wanted rates to be higher. The previous meeting, 2 of the members did say they wanted it to be higher. This time, the person who didn't vote to keep rates where they were was someone who wanted to cut rates by 25 basis points, 0.25%. So nobody wanted to raise, everybody wanted to either keep it where it is or cut it. So that suggests even more evidence that we are going to see a cut at the next meeting, or the meeting after that, or the meeting after that, sometime this year. It certainly shows that we're almost certainly at the top of this cycle, but that's what we kind of knew anyway. If we look at bank rate going back since the bank was founded, the Bank of England, that's back to 1694, you can see that the rate since then has averaged about 5%. In fact, between 17 and 1800, it didn't really move from 5%. It did dip below initially. But also, if you look back to the 1970s, the median rate has been 5%. So all we're really doing at the moment is kind of going back to that average. Of course, nowadays we'd expect it to be close to 0 because that's what we're used to. But what we'll go back to will be something more like 3%, I'd say, for bank rate. Given the neutral rate, which is what banks call the rate at which it doesn't accelerate the economy or slow down the economy. That's the estimate that economists now have for the neutral rate. But if we look at the rate increases, they were very brisk. So you can see that there were some really chunky increases. This one was 0.75% as inflation surged and the Bank of England had to react very quickly. But now we've been plateauing for some time, and the next move is almost certainly going to be down. My guess is that the downward move would be about 0.25%. It would be one of the small increments rather than a large increment, because there's no hurry for the bank to cut rates. I think it's more of a kind of signalling mechanism for them to say inflation's now under control, but we don't want to cut rates too much in case it surges again. So I think they'll be pretty cautious with the rate cuts. So if you're somebody that's earning money with a money market fund, if you're somebody who uses that interest, then the good news is that I think that the rate cuts will be slow, and that means you'll have plenty of time if you want to lock in more duration by going further out on the yield curve. I think you'll have plenty of time to do that. I think the bank will be trying not to upset the apple cart and give the system a shock when it's starting to cut its policy rate. So inflation, still high and sticky, unfortunately. Not as high as it was. So if you look at core inflation, this excludes food, alcoholic beverages and tobacco. The reason why central banks like this is because it's a better predictor of future inflation than one which includes those volatile components. Energy prices are all over the place, food prices as well. So by stripping those out, you get a better predictor of where inflation is going to be. Because policy, monetary policy, is a bit like steering a supertanker. There are long delays after you've changed the policy rate until it affects the economy. So they have to kind of steer the tanker where it's based on where it's going to be rather than where it is now. So this is why when Governor Bailey says that they don't have to wait until we reach this dashed red line, the 2% target, in order to cut rates, as long as they're convinced we're heading towards that 2% and the momentum is strong, then they're probably happy to start cutting rates even before we get there. In fact, in order to avoid an overshoot, that's probably what they'll do. So headline inflation includes everything. Core doesn't. Core inflation has been falling. There was a worrying period here, 2 prints previously, when it didn't fall, and there was a worry that it was going to carry on increasing, but that proved to be just a blip. The US actually saw something similar in January and February. They had a bit of an upward bump in inflation, but that might just have been a seasonal effect, according to Jerome Powell, and the UK saw something similar. But now it has moved down, and so is headline inflation. So that's good news for all of us. If you look at the annual CPI inflation rate and look at the changes broken down by the components of inflation, and this is a fairly granular breakdown, and this is between January and February. So these numbers add up to the minus 0.56% percentage point fall in the rate of inflation that we saw between January and February. The components which made it fall primarily were food and restaurants and hotels. So the cumulative increase in prices for food in the UK since 2020, if you plot them, looked like a kind of, I don't know what you'd call that, kind of sigmoid curve, where the cumulative increase is about 30% now, just a shade below 30%. But it has slowed down the rate of increase, which is great news. And that's been the biggest contributor to the fall in the rate of inflation over the last month to February. Restaurants and hotels, another inflationary driver previously, is also now falling. In fact, all of the components except these two, which is housing and household services and transport, due to energy prices not falling much or increasing slightly, both of those were in positive territory over the last month. So those were pushing up the rate of inflation, but almost everything else pushing in the other direction. So that's good news. If we look at the UK inflation rate compared to other developed markets, so here we can see the UK is the kind of white line, the very thick one, and then France, the UK was 3.4% for CPI inflation, France 3.2%, the EU average is 2.8%, Germany 2.7%, of course Germany's in recession as well, and the US, the equivalent measure for the US, which is hiccup, that's 2.2%. So the UK is still above the rest of G7, but not by as much. It seems as if things are abating here as well. We're seeing disinflation here as well. It just took a little bit longer and is a little bit stickier than it seems to be elsewhere. But still, good news. And it does seem as if we're out of the really awful period of exceptionally high inflation. So turning to the press conference, oh no, I can't turn to the press conference because there wasn't one. Let's just read out the tweet from Andrew Bailey. So I'll try and channel my inner Bailey, right? So today we decided to keep interest rates unchanged at 5.25%. Inflation's continued to fall, and that's very good news. Global factors that previously pushed up prices in the UK are fading. Great. And the decisions that we've taken on interest rates are also helping to bring inflation down. So they're taking responsibility for the fall. Interesting that everyone's now taking responsibility for that, including the ruling party in the UK, the Tories. But I think the Bank of England can make a case for it more strongly than the politicians. Because of this, inflation was down to 3.4% in February, and that's the lowest it's been for over 2 years. We've left interest rates unchanged again today because we need to be sure that inflation continues to fall all the way back to the target of 2% and stays there. He seemed to stress that in his video. So we're not yet at the point where we can cut interest rates, but the signs we're seeing are encouraging. Yeah, it's going to be later this year. Achieving low and stable inflation is the best thing we can do for people and businesses up and down the country. So they are doing. And I just hit the wrong button. Now, there wasn't a monetary policy report either. But if we flip back to the monetary policy report we got in February, just a month ago, just to remind ourselves of what the bank was expecting, essentially no GDP growth. We've just come out of a recession for 2 quarters and growth is starting to improve. So that's reassuring. And since that meeting, one of the things the notes that came out with this policy announcement, the minutes, suggest that GDP has strengthened a bit after a very disappointing end to last year. But the CPI inflation forecast was that we'd get back to 2.3% inflation by Q1 of 2026. That was the expectation. But both in the US, Europe and in the UK, the inflation rate was higher than expected. So it seems to be a universal thing at the moment that it's stickier than policymakers expected it would be. And that's also pushed up rate expectations and meant a delay in expectations for when the cuts will happen. But for the US and the UK at the moment, even after this meeting, the expectation now is that we will get some rate cuts. So that's good news if you're paying a mortgage, for example. So unemployment rate not expected to surge. You know, in the UK, it's expected to go up to about 5%. Although looking at the unemployment, as we will in a moment, it doesn't actually seem too bad. It's certainly at the moment, it doesn't look like it started surging. And it does. And the Bank of England doesn't expect it to surge. So something like 4.9% is going to be the peak, and that's going to be in 2026 and 2027. So not good news if you're a worker and you're you lose your job. And of course, just a few percentage points does mean hundreds of thousands of people losing their jobs. But at least this isn't going to be a full-on, 6, 7, 8% unemployment rate. And bank rate is expected to fall down to about 3.2% by the beginning of 2027, by Q1 of 2027. So don't expect it to fall to 0 again. It won't. It'll fall to something like 3.2%. That's the rate at which the bank thinks it's probably neutral. The reason why we know that is because if inflation is at something like 1.9%, which is what they expect it to be at, then it's below their target. So this will be their we're not tightening or loosening conditions rate. So 3.2 is where we're headed. Currently we're at 5.25, so we've got about 2 percentage points of cuts to come. And I think we'll start sometime this year. So this was the GDP growth projection, and that was from their February report. you can see it looks pretty awful. Yes, it could dip into negative territory. It does start to recover towards the end of 2025 and 26, but it's actually looking better than people expected. Oh, and incidentally, maybe I should mention this now. I have got a UK overweight in my equity portfolio, a small one, but this is why I think it's usually useful to look at GDP and macroeconomic data, because the time when you buy stock is not when things are starting to improve, it's during the recession, because that's when nobody wants to buy the stock, because everyone thinks it's always going to be bad news. But in fact, things are starting to improve. So I think we are starting to see the light. If you look at the market PMI surveys, the purchasing managing surveys for the UK, it's still not great, but it is showing signs of improvement and improved sentiment amongst UK consumers and businesses. So I think we are turning a corner. I don't expect huge growth, but I think things are getting better. CPI inflation, CPI numbers. This is the forecast for CPI, assuming that what happens to the policy rate is what happens in markets, or that you keep rate fixed at 5.25% forever. So that's, restrictive forever, pushes inflation below the target by 2026 in the central case. If you follow what markets expected in February, then it would reach target roughly mid-2025, maybe a bit towards the end of 2025. But generally, the market and the forecast from the Bank of England is that we're going to get back to 2% by about the end of next year. If we look at nominal pay growth, then we can see that in the UK, it's still pretty high. So this is not adjusted for inflation. This is average weekly earnings in the UK, total pay, including bonuses. That's the blue line here. And that's currently growing at 5.5%, which is way above where we were in 2019 when things were normal. It was more like 4% or a little bit less. Currently we're seeing 5.5. We did see it surge up beyond about 8% for some time. But at the moment, it's above inflation. So that's good news if you're a worker in the UK. Prices aren't increasing as rapidly as your wages are. The drawback is that while this remains high relative to where it was pre-pandemic, that's going to push up services inflation, because services are very much driven by wages. And if this remains high and sticky, then it's likely that services inflation will stay high. Although there was a comment, which I'll read in a moment, which is probably quite encouraging. But total pay 5.5, CPI 3.4, woohoo. Right, that's good news for workers, not good news for the Bank of England. So the total real the total real rate of wage growth above inflation is currently 1.3%, which is good news for workers. If we look at the average wage in the UK, the total real pay, and do adjust for inflation, the shocking thing for the average UK worker is that we've had 16 years when there's been no real wage growth. So there was a kind of encouraging period here when we saw quite high real wage growth. That's this spike that you can see here, the positive real wage growth. But then that kind of abated, and now we're getting closer to the point where inflation is going to start beating wages potentially, or they'll be closer matched. But what it means is we're no richer now than we were in 2008, which is pretty shocking. Almost every generation that's come before us, the standard of living has been better since the Industrial Revolution. What we're seeing over the last 2 decades almost is no real wage growth. And I think this is going to be a real problem. If you're somebody who's young, you really do expect to have a better standard of living than your parents, not worse. So I think that's going to be a real problem for politicians as well. Clearly, this is the graph they don't want you to see, because it doesn't look great for politicians if they can't manage to increase the standard of living for their citizens. But still, it's just not a good story. Not a good story at all. If we break down inflation into goods and services, you can see this sticky services inflation, that's the yellow line, is currently still at 6.1%. There's very little sign it's come off the peak by much at all. So there is disinflation in goods, very strong disinflation. It's only 1.1% inflation, down from 15. But for services, which is driven very much by wages, that's still pretty high. And that's worrying for the bank. And I think the Bank of England probably will want to see more progress in this services inflation before they start to cut rates. But hopefully that is coming down. The latest print was significantly lower, so perhaps that's just a delayed thing. We're probably going to have to see wage growth start to abate before that really starts to fall, but it is moving in the right direction. And it's not just the UK where we see services inflation being sticky and much higher than goods inflation. That's true in the US, that's true in the euro area as much as it is in the UK. So you can see goods inflation in red, services inflation in blue, and in all three regions the services inflation has stayed higher than goods. In the UK, we've still got a pretty tight labour market. In other words, if you look at unemployment, for example, that's still quite low, 3.9% in the UK. That's the number of unemployed people as a proportion of the people who are economically active, which are 16 years or older. So 3.9% is historically very, very low. You'd have to go all the way back before 1980 in order to see an unemployment rate that low. So if you're looking for work, it's very likely you can find it. And if we look at another measure of the tightness of the labour market, which is the number of job vacancies relative to the number of unemployed people who are looking for work, you can see that that's now peaked and it's starting to, turn into a looser labour market, but it is still tighter than it was pre-pandemic. So pre-pandemic it was something like 0.6. Currently it's still 0.67, so still quite tight, but it is getting looser. So that's probably a precondition before we start to see wage growth fall and before we start to see the goods services inflation fall as well, which is so wage driven. So it is encouraging to see the tight labour market loosen somewhat. The idea here is that if you've got lots of people looking for one job, then the employer can afford to cut wages. Whereas if you've got loads of very abundant jobs, lots of roles available, then it's a kind of employees market and they can demand higher wages. But if we move away from that tight labour market to one which is looser, then you can't have such strong wage negotiation by employees because there are other people who are able to take their job. So that's the logic behind this. If we look at the number of economically active people in the UK, that's kind of not increasing much because one of the problems we've got in the UK is many people are not able to work, even though they're technically in the age brackets where they could work. A lot of people have retired and don't want to go back to the labour force, and lots of people are ill, interestingly, and not able to go back to the workforce. So the number of economically active people has kind of plateaued, and has plateaued for some time. And what was interesting, if you compare the UK to the rest of Europe or the rest of the world, is we compare our labour force to the labour force before the pandemic, we've had less people return to the labour force after the pandemic than in other countries. And that's worrying because it creates a tight labour market and pushes up wages and also pushes up inflation. If we look at the number of employed people, that's also increasing, but not as much as the number of employed jobs, which has surged. So lots of demand for people to work, but not enough people to fill those roles, unfortunately. You can solve that with immigration. That's one way to do it. That's not politically popular at the moment, but that's one way you can solve this this worker shortage. In the US, for example, immigration certainly helped loosen the labour market. That's one thing Jerome Powell was saying a lot. In the UK, we've had a substitution of labour, not from the EU after Brexit, but from elsewhere in the world. So it'll be interesting to see how we kind of crack this problem. Mortgages, this is the thing that a lot of people are interested in. If you're coming off a fixed period, we have seen the mortgage rates come off their peaks, but they have started to rise again recently. This is for a 2-year fixed rate. This is data from the Bank of England. And if your loan to value is 95%, then the rate is currently about 5.7%. If you're borrowing less as a percentage of the value of your house, the rate you pay is lower, so something like 4.6%. And obviously you're less of a risk to the bank if that's the case, so they charge you less interest. And yeah, that is starting to fall. And if we do see bank rate fall significantly over the course of this year and next year, then I would expect to see these rates normalise. So I think if you are looking to fix again, if you can refix later on, it might be better. So hopefully you're not fixing at the beginning of the year. Hopefully it's towards the end of the year when rates will probably be lower. But it's certainly looking like they're going in the right direction for now. So that's it, and that's it for my bit. But now we will answer some questions. And so please do a super chat. It helps us a lot. Obviously, economically, it helps us. And if you are a supporter on YouTube, we'll push you to the front of the queue to answer your question. And let's say we'll do this for 20 minutes. Usually we get lots of questions, but let's say 20 minutes initially, and we will try and answer the people who are super chats and also the supporters on YouTube first. And please do like and subscribe, don't forget. And if you do want to join our community and learn more about investing, then you can do that by going to our website, PensionCraft.com. And I'll get in trouble if I don't mention that. And here comes my dog. He's going to mug me. Oh, hello, Ted. Fancy seeing you here. We've worked out that he's actually trained Laura and I. He doesn't really like these treats as much as the biltong, but he knows if he comes and gets this, that Laura then rattles the biltong box downstairs and then he gets the good stuff. So he'll choke down these extremely expensive low-fat treats and then go for the South African biltong downstairs. There's one more. You're going to do a treat. You're going to do a trick. Why don't you do a trick? You've got to earn it, mate. He does this thing where he can stand up. You ready? Oh, very good standing. Very good. Clever boy. Hours of training went into that. Now the box is empty. There we go. So you're going to go downstairs now, Ted? Laura's going to rattle the box. She's going to rattle the box and you go downstairs with the biltong. While the people watching think of questions. Yeah. You're going to go downstairs? Downstairs? Laura? Oh, there he goes. Good. Brilliant. So, yeah, we'll answer some questions now. Doesn't have to be about the Bank of England, but obviously, you know, we've just talked about it, so that wouldn't be a bad topic. Does it make sense? Oh, we have got some super chats. Very good. Please do like and share. Laura's reminding me. Gavin Lawrence, super chat. Thank you. And he says, Bloomberg Term Fund contribution. Nice jumper. I was making fun of Jerome Powell last night because he always wears the same tie, and then someone pointed out I always wear the same top. So that's a fair point. For live streams I do, not for the videos. But anyway, yeah, that's my contribution towards my Bloomberg fund, so I can get a Bloomberg terminal. That's the one thing I miss about banking, and the fabulous colleagues as well, which I had in the investment banking world. Miss them as well. Gavin Lawrence says, don't you feel that we didn't get growth during zero interest rate policy period, just asset price inflation? That's a good point, actually. Could argue that the higher cost of credit is due to increased financial discipline. Oh, interesting. I hadn't heard it described as discipline before. But But I think overall, you're right. I think what we saw during the period of zero interest rates, the decades when they were at zero, was huge asset price increases in the stock market, and it was something which increased wealth disparities, because if you were wealthy going into the post global financial crisis period of zero interest rates, then you probably had lots of stocks or lots of bonds. Both of them did well. It was like an everything rally. And that meant that the people who were rich at the beginning were even richer by the end of it, because they had stocks and their wealth increased even more. Or if they had pension wealth, that would increase as well. If they had house wealth, because interest rates were zero, that pushed up house prices too. So almost everybody who was wealthy initially, for one reason or another, depending on which asset mix you had, did very well out of it. Whereas poorer people who don't tend to own stocks or property, or have high pension savings, didn't really benefit from the zero interest rate period. So economic growth as well, you're right. We really haven't had much productivity growth in the UK at all, in real terms, for the last 2 decades. And I did a plot of house prices recently. I did a video looking at house prices in the UK. And it's not a coincidence that house prices in the UK haven't risen at all in real terms for 2 decades, because wages haven't. And that's one of the graphs we saw tonight. And prices and wages, house prices and wages tend to rise together. So I think, whether you look at productivity, wage growth, house prices, in the UK, we just didn't do very well at all in real terms for the last 2 decades. And the watershed moment was the global financial crisis. We got pretty good GDP growth going into that because the financial sector was growing really quickly. And that's been a very productive sector for the UK. But of course, after that global financial crisis, it got a whack due to the fallout of the global financial crisis. Then we had Brexit in 2016, and the UK banking sector is no longer as attractive because it doesn't offer a gateway into Europe. Plus, you can't passport things into Europe as easily as you could previously. So I think that's one of the problems. The stock flows in the UK, the volume on the stock market in the UK also is not great. So I think there's a whole bunch of reasons why in the UK the banking system and the banking industry no longer contributes as much as it did, and it's been hobbled by some policy choices. But I think if productivity comes back, it's probably going to be other sectors which help do that. Maybe technology, maybe I don't think it's going to be manufacturing, but interestingly, I think it's services that we're very good at. That's our biggest export. So if we can somehow produce new services, better services than other countries, maybe that's our way out of this productivity slump. And that's a matter of education, and it's not something you can turn around quickly. But it is encouraging to see that the Shadow Chancellor, Rachel Reeves, is talking about using the OBR's suggestions as to what's growth positive for policy to feed into Labour's fiscal plans. And that's kind of apolitical in the sense that the OBR, the Office for Budget Responsibility, doesn't have a political axe to grind. They're just looking for what they think will give the best growth. So I think that's a kind of positive development. Kind of like you make the Bank of England independent and able to set monetary policy. Clearly, they're not going to make that happen for fiscal policy, but they're certainly going to be informed by a neutral body, which isn't a bad thing. So that was kind of interesting to hear that. Comment from GT, who's one of our supporters on YouTube. We see the little crown next to your name, GT. Is that a reference to gin and tonic, I wonder? Or are those your initials? Great content, as always, Ramin. Now thinking gilts. Okay, I do talk about gilts a lot. Please discuss tax treatment outside an ISA or SIP. Specifically, TN25, a profits, capital gain, income, bit of both. What a great opportunity. That sounded like a planted question, but I'll make the best of it. Thank you for that very much, GT. I'll log into our website and I'll share in just one moment. And we'll have a look at our yield curve tracker. So let me share this with you. So this is what it looks like if you're a member of our community. This is your dashboard. It's got all of the content that we produce, recent members content, the latest videos with no advertisements in them. I cut out the advertisements, any courses you've registered for, and the trackers. So let's launch the trackers, which my colleague Patrick Hadot updates every day. And our macroeconomic ones are going to include UK yield curve. Here we are. So you can either have this in the form of a table if you want to look at the individual bonds, or you can just look at the yield curve. So what you can see here, each of these circles is one bond issued in the UK. There are 64 of them outstanding at the moment. Oh, didn't mean to do that. 64 UK gilts outstanding with maturities of between 0 years and 50 years. So TR73 is our 50-year bond. That's got a lot of duration risk. And you can see the shape of the yield curve at the moment is kind of kinky. So it's higher at the short end than the long end. So really short duration bonds have the highest yield. And the question was about TN25, I think, this one. And if we zoom in on the short end of the yield curve, and TN25 in particular, you can see the coupon on it, so that's the regular payments that it's been paying since it was issued, are only 0.25%. So a very small interest payment. So if you own £100 of the bond, it's only going to pay you 25 pence every year, split into 2 payments of 12.5 pence every 6 months. So very small interest payments. And that means that if you look at the total yield to maturity, which is 4.4%, which is 4.6%, if we subtract the coupon, 0.25, all of the rest of the yield will be capital gain. So if we look at the price of TN25, which we can do with our gilt table here, we should be able to see the price here. So TN25, if we expand this thing, the price as of yesterday's close was about £96.37. And so you can see that if you hold that to maturity, which happens on January the 31st in 2025, you're going to have a capital gain of £3.63. So that's going to be pure capital gain. And the capital gain is going to be about 4%. So the vast majority of the yield is going to be capital gain. And in the UK, capital gain isn't taxed. So all you're going to pay tax on for this thing, if you hold it outside an ISA or a SIP, will be the coupon, the very small coupon of 0.25%. And the way that's taxed in the UK is as income tax on savings income. So let's just get let's see if I can find it's called tax on savings interest. And you also get a personal savings allowance. So depending on your income tax band, the personal savings allowance is £1,000 if your basic rate, £500 if your higher rate. You don't get any personal savings allowance if you're additional rate taxpayers. And so if your coupon is below that personal savings allowance, you don't have to pay any tax on it. But it is interest on savings, and that's the way it's taxed. So it's like an income, I guess. There is an example here. Let me just share the example because it's a nice example from HMRC. So they give this example of somebody who earns £16,000 of wages and £200 interest on savings, which could be the bond coupon. Bond coupon is one of the examples of savings interest. Your personal allowance is 12,570, so your wages gobble that up. The remaining 3,430, where you've subtracted your allowance, reduces your starting rate for savings by 3,430, and your remaining starting rate for savings is 1,570 because you've subtracted the 3,430, and so you don't have to pay tax on your £200 savings interest. So I don't know if that was helpful, the kind of illustration there. But the allowance covers bond income. So income on government bonds or company bonds is treated as savings income for the purpose of tax. But because it's 0.25%, in order to have a chunky contribution to your personal savings income, you'd need a very large principal amount in order to move the needle. So that's why that bond is particularly good and tax efficient outside an ISA or a SIP. Now, going back to the yield curve, if you're going to buy a bond which is in an ISA or a SIP, where you don't have to pay income tax, then you just go for the one which has the best yield. So instead of this one, which is TN25, you might choose this one, which is small on my graph because it's not tax efficient. But if you don't care if it's in an ISA or a SIP, it's better because the yield is higher, 4.7%, or this one, 4.75. It's all at the short end of the curve at the moment. One reason why the policy rate is important is because once this short end of the yield curve goes down, what we'll probably see is the long end might start to rise as growth starts to improve, in which case what we'll see is a more normal looking yield curve, which is upward sloping. So the short end, once the bank is finished, will be about 3%, the long end usually about 5%, and then you get compensated for taking duration risk. So it'll make sense at that point to buy a longer dated bond, and I made a video about that recently, which is out on YouTube if you're interested. So there we go, TN25. What a great setup that question was. Thank you, GT. But anyway, if you want access to those trackers, you have access to it as a part of our Prime. What am I talking about? Try again. So if you want access to those trackers, if you're one of our premium members on our website, to learn more about that, just go to PensionCraft.com and you'll see how to join the membership. The fee is very reasonable. We've tried to keep it low. We haven't increased it after the inflation surge. So in real terms, our income has fallen significantly. But we want people to be able to afford the membership because we think it's a valuable service. So £16 a month, I think, and you can cancel at any time. Although you get a month free if you lock it in for a year. So that's the way it works, and it is quite sticky. We have over 1,000. We have about 1,000 members now, and we find that it's fairly sticky. People stay with us for a long period of time, presumably because they find the service useful. So yeah, that's the way the membership works. Oh, lovely! We've got a comment from Scipio Africanus, the great Roman general and emperor, who says, who's done a super chat. Thank you very much, Scipio. He says, do you have any idea why SWLD has slightly outperformed MXWS despite the latter being synthetic? Thanks again, great content as always. So let's have a look at those two. SWLD and I'll use SharePad for this. I'll share my screen. Oh, I forgot to show you Sterling. Sterling weakened today because, yeah. But anyway, there we go. Move my face. So this is SWLD. It's the Spider MSCI World ETF. So this is a developed market tracker. And the one that you're talking about was MXWS. So we'll add that to the graph. Add MXWS. There we go. So this is the same index, but this is Invesco's tracker. So this is a, let's not do hourly, let's do daily. And let's get as much history as we can. So they are very similar, very similar. So I don't think there's much difference there, actually, Scipio. Yeah, I really can't see much difference between the two. Which is what you'd expect. I mean, they're tracking the same index, MSCI World. And but I think your point is one about one being synthetic. So MXWS, yeah. So let's look at Invesco's description of MXWS because we'll see that it's synthetic, and that's important for a reason we're about to describe. MXWS Invesco. I like Invesco's website because it's actually pretty good when it describes the funds. There's a lot of detail on their page, which I like, because you really want to understand the funds, and if they don't give you the correct information, it makes it that much harder. So the expense ratio is 0.19, which is pretty good for a global index. For a developed market index, the one I've got is 0.12, but you can see the assets under management are chunky, so $46 billion, and we'll see if it's synthetic. Usually they've got the swap counterparties. Yeah, so this is synthetic. Yeah, here we go. So what you can see here is swap counterparty exposure. The way these things work, when a company pays a dividend, if it's held inside an ETF and the dividend is paid in the United States, if it's a US stock, not all of that dividend makes it through to the fund manager and through to you. And that's because your fund is probably domiciled in Ireland, in which case there's a 15% withholding tax. So 15% of that dividend will be held by US tax authorities. You only get the remaining 85%. Whereas if you buy it via a swap structure, like this fund, what happens is the swap counterparty, which is Morgan Stanley, SocGen, JP Morgan Chase, Goldman Sachs or Citi, sit on the exchange and the stocks are owned on their balance sheet. It's as if those banks own the actual stocks in the index. What they then do is, with a derivative, they agree to pay Invesco the daily returns as if they own the basket of stocks. So if the stocks go up, they pay Invesco. If the stocks go down, Invesco pays them. And this way, economically, it's exactly as if the Invesco owns those stocks, although it doesn't really. They're held on the balance sheet of these banks. So that's the way it works. But because they sit on the exchange, these companies, these investment banks, they don't have to pay the withholding tax. It's as if they're American companies, because many of them are. And they have subsidiaries in the US, which are US companies. So that's passed on to you as a saving, so you don't pay any withholding tax at all. So you get to keep all of the dividend. So what Scipio is really asking is, why isn't the synthetic fund, which is MXWS, which I think is in a slightly different colour, why isn't that outperforming the one which isn't synthetic? And that's interesting. It really isn't. There really isn't much between them. And you would expect to see a difference between them, because if you're keeping, so let's say that the US pays a dividend of 1.5%. If you're keeping 0.85% of that, so 0.85, it's a percentage of a percentage, of course, so it's not going to be a huge outperformance. but it is significant. If you think about how careful we are with our expense ratios, so 1.5%, and we're going to keep, the difference would be about 0.15. Yeah, it'll make about 0.23% difference every year. So about 23 basis points per year is what you'd expect the outperformance to be. So 1.0023. Yeah, 1.0023. And this is a period of how many years? This is about from 2019 to 2024. So that's 5 years. So the compounded difference I'd expect would be about 1.2%. So maybe we can't see it on the graph, but you would expect a 1.2% outperformance over this period. So if you've got the choice, personally, I'd go for a fund which has a low fee in the first place, and also which has this synthetic exposure, because you get to keep all the dividend. There is a kind of swap fee. I wonder if that's making the difference. So the management fee for the fund is 0.19%, and then the swap fee is 0.03. So the total is going to be 0.22%. So maybe that's gobbling up some of the gain. Maybe that's the difference between the two. So what's the spider tracker? Yeah, the fee there is 0.12. So all in, the fee for the Invesco one is going to be 0.22. So it's going to be a 0.1% difference in the overall fee. So half of the outperformance is gobbled up by the extra fee for this fund. But still, you would expect slight outperformance over the long run. But it shows you when the cost of funds is so low, and we're talking about a few tens of basis points difference, that's a good situation to be in. It's great to be having these conversations. When I first started PensionCraft, it was very difficult to find global trackers that were accumulation, that had a low fee. So the fact that we're talking about this and tiny differences like this is great. I think that's good. But I think that's why the two are not much different. There's about a 0.1% difference net of fees between the two, Scipio. So I hope that answered your question. So I think we'll kind of have a quick look at, well, I'll answer one question which isn't from a supporter or a super chat, and then we'll call it a day, I think. Always an interesting conversation here. Someone called Daniel Brereton says, do you think we're over-reliant on services? Feels that way to me and leaves UK very exposed. Well, it's really hard to turn an economy around and say we should get back to manufacturing, because it's not something we're particularly good at, or we're not dominant in that sector, put it that way. Whereas for services, we do add a lot of value. It's just difficult to classify what we're good at. I think that's the problem. It's kind of a mixed bag of services that we provide the world. Innovation, I think we're very good at that. You could describe that as a service, I suppose. Software, another thing that the UK is good at. And, even some hardware, things like ARM, the chip manufacturer, chip designer. That was a British company. Of course, it chose to list in the US, unfortunately. But are we over-reliant on services? Yeah, I suppose that's true. But the question is, could we switch back to manufacturing, and would we want to in the UK? Probably not. I'd say it's better to focus on what we're good at and just do more of it, because that's the easy thing to do, rather than trying to compete with other countries like China in EVs. That's not going to happen. So I think, being niche is not a bad thing. We've just got to resign ourselves to the fact that we will be a niche player globally, because we're a small country, but we can punch above our weight because of our high quality education, the fact, we speak English, which is always a boon in international trade, a good rule of law in the UK, and a very creative population. I shouldn't, I wouldn't do down the UK. I think, we're an incredible country, but of course I would say that, right? But I don't think we could shift away from services if we wanted to. One more question. Let's see. I have an Aegon pension. Oh dear. Okay, so last question is from Horsey, who says, hi Ramin, I have an Aegon pension, which is a universal lifestyle collection. It's a total charge of 1.03%. Is that high? Yes. Short answer. So if you run your own pension on a SIP platform, then for the platform itself, if you've got, something like a few £100,000 in your pension, as a percentage, the fee almost goes to zero if you're on a fixed fee platform. So for example, many of the fixed fee platforms in the UK, the fixed fee is something like £200. So if you're paying £200 a year and you've got, say, £300,000 invested, then as a percentage fee, that's 0.07%. So the more you have, because it's a fixed fee, the percentage goes down with more money, but the fee doesn't go up. So your platform becomes almost free if you have a big pension. So if you have 600k in your pension, then it's going to be 3 basis points, 0.03% fee for the platform, almost nothing. The fee for the funds, as we've seen, if you go for a developed market global tracker, you can get something for about 0.12% now, maybe even lower. There's a new one that's come out from Amundi, an income fund, unfortunately, but that the fee there is 0.07. So we're rapidly getting to the point where you can have an all-in fee for your pension of something like 0.1%, which is a tenth of what you're saying you're being charged. So, I think if you're paying more than an all-in fee of 0.2, you should really think about whether you can do it more cheaply, because you don't get any benefit from paying more for your pension. They're not going to add to your return by selecting funds which are particularly good at performing well. That Kool-Aid is just no longer being drunk by people in the UK, the outperformance Kool-Aid. How can they add value? I don't think they can. I think they can just add value by not charging you a high fee and not standing between you and markets, siphoning off your return. I think that's how they can add most value. So yeah, that's a lot. And a lot of the pension crafters, what they try to do, some of them can do this, they speak to their HR people at work, and every year they sweep out their contributions into their personal SIP. So the company carries on contributing to their pension. Of course, you want that. And they even do salary sacrifice to maximise the amount that goes into their pension. And then they sweep out the amount every year and build it up for another year and then sweep it out. And that way, the stuff that goes into the SIP, you can keep it low fee. You have control over what's invested. You've probably got more investment choice. And you can keep it really simple and manage it yourself. So if you do that, you've got kind of the best of both worlds, employer contributions and the fact that you've got control of the money once it goes into the SIP. So certainly that's one thing some of them do. But yeah, you're paying a lot. So anyway, look, that's it for tonight. And thank you for joining us. Don't forget our membership. Go to PensionCraft.com to become a premium member. You get access to the trackers that you saw, and lots of members-only videos, and the Slack application so you can talk to other members of the community or ask me questions if you want to at any time. I try to answer as quickly as possible, but the community usually answers better than I do now, which says a lot. They're very kind people, I think, but also very helpful people, and now increasingly knowledgeable people with a huge combined experience. So do check out our membership, subscribe to the channel if you haven't already, like this, an even lower ask. So please do that. That helps us. And thank you for joining us tonight. And good news about the UK economy. It's always good to talk about that. Inflation falling, growth kind of turning a corner. Not amazing, but good. And it's always nice to have some good economic news to share. So thank you all for joining us, and we'll speak again at the next live stream. Take care, everyone.